Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. How could I not be? It's crazy to think we are in June now.
I know.
The year
Far
is
out.
half over. If 2025 was the year you were going to start investing, well, I hope you have started, because
What a year it's been.
You've missed a market that's doing a lot.
We have.
Yeah.
We haven't. You have, if you haven't started investing. But anyway, we've got a massive episode today. We're going to cover off all the news that is making headlines. We're going to look into the portfolio of one of the world's most well-known investors who has completely liquidated everything except one investment. And we've got two community questions to close out the episode with our Unhelpful Desk.
News and markets.
Headlines we're going to cover off today. Australia's best asset class revealed. Tesla and Nvidia make headlines. Volkswagen's Dieselgate is finally sorted. And the latest acronym in finance just dropped. Wow, what a segment to start with, Ren. Wow, Australia's best asset class revealed.
Well, yeah, so we got some data from the Australian Property Institute looking at asset class performance over the past 20 years. Do you want to guess what they had the best asset class as?
Let me guess, property.
So, no, they compared different property asset classes. So, the baseline, the Australian residential housing across regions and different types of housing as an asset class, up 154%.
Over
20 years.
Okay.
Not bad.
Yeah.
More than doubled your money.
Well, that's reasonably in line with W money every 10-ish years. Reasonably.
Yeah, sort of. But their big finding was that agricultural land has smashed the performance of residential, up 256% over the past 20 years. But what's more, some particular pockets of agricultural land absolutely smashed it. So, Tassie, up 689% over 20 years. Not bad. Now, Bryce, your roots are in the Riverina.
They are.
Yes. The New South Wales Riverina over the past 20 years. Do you want to have a guess?
What it's up?
Yeah, farmland.
420%.
Not bad. 400% on the nose.
Nice.
Yeah. But they all...
Jeez.
I mean, you should have stayed in Wagga and bought some
No,
farmland.
I'm going to tell you something in the story in a second.
Okay,
but yeah.
okay. But the top performing region was the Western Victoria region, up more than 800% over the past 20 years.
So Dad was an OG farmer.
OG farmer?
Well, like his OG career was a farming.
Okay, yeah.
And he owned a farm in Hamilton, smack bang in Western Victoria.
Oh, no.
Yeah, I don't think I'm going to tell him those numbers.
Oh, damn.
Yeah.
Wow. Okay,
Anyway.
what could it be? So, look, those are the numbers. We then wanted to compare it to the Aussie stock market to see which has performed better over the past 20 years. So, here are the numbers. The Australian All Ordinaries Index, 2005 to 2024, up 93%.
Whoa,
Ooh.
that's shocking.
Wow, doesn't even beat residential
That's
housing.
almost less than inflation. 3% a year.
Yeah, okay.
It's like it's like limping past inflation.
But here's the thing you've got to remember. What do we know about Aussie large cap stocks?
Dividends.
They love dividends. A lot of Australian investors' total return comes from dividends. So then we reran the numbers. The Australian All Ordinaries total return. So if you'd reinvested your dividends every year, up 372%. So take that,
That's
farmland.
nuts. That's wild.
All of a sudden, the
Take
All
that,
Ordinaries
farmland.
beats farmland and more than doubles Australian residential property. So cop that property.
Cop that, yes.
Now, if only we could do 95% leverage into stocks like we can now do into property.
Well, you can.
Not 95%.
Not 95.
Yeah.
That's true. Yeah.
So anyway,
More like 60.
that's a look at some asset classes. To be honest, I think my biggest takeaway is whatever you'd invested in, you'd be happy
20 years ago.
if you'd invested. And I bet anyone out there that 20 years from now will look back and have a similar conclusion, that whatever you invested in, you'd be happy you started investing.
Really? Anything?
From my list of
Broad strokes.
from my list of investment options, stocks or property.
Nice,
Yeah.
nice. Well, speaking of stocks, two large caps that have made headlines, Nvidia and Tesla. Let's start with Nvidia, who have reported recent quarterly earnings and have beaten market expectations. So overall revenue was up 69% to $44 billion for the quarter. Revenue that came from their data center division, and this obviously includes their AI chips, that grew 73%. It's just wild, the revenue growth they're seeing. Profit up 26% to $19 billion. And the stock itself was up 6% after the result was announced. This is off the back, though, Ren, of some regulation that the US has brought in to limit the amount of chips that can be exported to China.
Yeah.
The company, as part of the result, gave guidance that they said would be $8 billion higher except for lost sales from this recent export restriction for their H20 chips. Jensen Huang, the CEO, has said that they're now closed off to a $50 billion industry in China.
Although he did say that they're going to try and re-engineer Blackwell chips, which is their latest, to make them like China
Safe?
Yeah, is that what they use? Yeah. So they're going to keep trying to find ways to sell into China. It's such a big market.
Yeah.
And to comply with US export restrictions on advanced technology. I mean, this company just keeps on doing it. And it's
does.
like, I don't know, there was a lot of talk early days about like, is there overinvestment in AI, and is there going to be real value being recognized in AI? I said this in an episode of Get Started Investing, which is yet to be released, but it feels, in my mind, we're kind of at the third generation of AI investment. It moves quickly. First was by the AI companies, then it was by the AI picks and shovels companies like Nvidia and Supermicro. Now I think we're starting to see some real value being extracted from everyday companies utilizing AI. And so the more that plays out, the more that will justify the investments in the Nvidia chips and the like. So I don't know. Obviously, Nvidia has run a lot, but it's pretty compelling.
Well, we're going to look at what a very well-known investor is doing with Nvidia in the next segment. But let's turn to Tesla, where a letter has been written to the Tesla board from a coalition of activist investors, large pension funds and labor groups who represent about $1 trillion worth of Tesla stock. The letter outlines 4 key demands from the Tesla board. First, they urge the board to require Elon Musk to commit at least 40 hours a week to Tesla. They want a clear plan for CEO succession, both in the short and the long term. They want addition of at least one new, truly independent board member with no personal ties to Elon or any other current directors, and a policy restricting outside board commitments for all directors. I guess there's a real sort of fear from these investors that Elon's distracted and there's not enough proper governance from the board given their close ties to Elon and the wealth that they've all created off the back of him.
I'm just trying to do some quick maths on what you said there. A letter of investors representing almost $1 trillion. So Tesla's market cap at the moment is 1.12 trillion. Elon owns 13% of the company. So call that rough 150 billion. So basically, are you saying this letter comes from everyone who owns shares in Tesla but Elon?
Yeah, you're right, Ren. Look, I said almost $1 trillion.
Okay, almost is doing a lot.
Don't have the numbers right in front of me, but look, it was enough. It was a fair chunk.
Yeah. Unsurprising. The first demand being Elon commits to 40 hours a week is interesting, when I think he's been out there saying that he's back to sleeping on the Tesla factory floor.
He's back to sleeping on the floors of his companies. I think the XAI, SpaceX, yeah.
Tesla.
And 40 hours for him, he works, says he works 120-hour weeks, so it's nothing.
Well, I mean, you say it's nothing, but 120-hour weeks divided by 4 companies,
Huge.
if you did it equally, it's still 30 hours each.
Yeah.
Anyway, look, we will see. We will follow this Tesla story. I'm not betting on them, but I would. You'd be a brave person to bet against them as well.
Big time. Yeah.
You don't have to swing at every pitch in investing.
Yeah.
And Tesla is a pitch I'm happy to just observe.
Yeah, big time.
All right. Well, let's talk about a rival car maker, one that caught my eye. Bryce, do you remember the Volkswagen Dieselgate?
Was this where they something to do with their muffler, where they were saying they had no emissions, but they were releasing a heap of emissions?
Yeah, they lied about their emissions scandal.
Yeah.
It was back in 2015. It was
There's
unveiled.
a good doco on it. That bad, dirty money or something.
Yeah. So the reason that is in the headlines literally 10 years later is the case has been winding its way through German and European courts, finally finished.
Wow.
2 former VW executives have been given jail terms, while 2 others have been given suspended sentences. Oh. And I found this interesting.
After 10 years.
Yeah.
Wow.
Because one thing that grinds my gears about American corporate regulation is these negotiated settlements where companies behave badly and then they go to the Department of Justice and they negotiate a financial penalty.
Yeah.
And the classic example recently is Boeing for the 737 MAX crashes where over 300 people died. They negotiated a financial settlement and no one was held responsible. Personally held responsible.
Yeah.
But similarly, there's a story that I always go to about these negotiated settlements. HSBC back in the day in Mexico was facilitating money laundering by the drug cartels to the point where they literally rebuilt the teller windows so the cartels could get more cash through the windows.
Yeah.
They negotiated a settlement with the Obama Justice Department, paid a fine, no one got held criminally liable. If you or I laundered money for the drug cartels, we would go to jail, but they didn't.
Yeah.
But you know what the kicker is? 5 years or, years later, they were doing it again.
Yeah, it's unbelievable.
So, you know what? Shout out to the Europeans for some justice.
Yeah, sending them to jail. Yeah, it's good. It is very frustrating seeing how that plays out in America.
Negotiated settlements. Hate it.
Yeah.
All right. Well, anyway, look, that's enough. We'll get off our high horse and move to our What The segment. Now, people who subscribe to our daily news email will be familiar with these What The's. We share one each day. It's something that took our surprise in the finance industry or in business more generally.
Yes.
And today we're saying what the to the new acronym that just dropped in finance. We know that finance loves an acronym.
Yeah.
ETF, LIC. Well, how about this one, Bryce? TACO. TACO.
That's it, the taco trade.
What does it stand for?
It stands for Trump always chickens out.
Right. Yes.
And effectively, the trade or the taco trade represents where Trump comes out and says something, he's going to put tariffs on a country, or he's going to do X, Y, and Z, and then within a matter of weeks or months, that is completely reversed, or he walks back on it, and subsequently the stock market has a bit of a V-shaped recovery, or whatever investment was impacted rebounds. And so that taco trade.
The taco trade is basically buy the dip when people panic on the news because Trump will chicken out. And, they point to what happened with China. They point to what happened with Europe.
Just tariffs generally.
It was literally within a week. He said 50% tariffs on Europe and then he walked them back. And now, some people say it's a negotiating strategy, and maybe it is, but otherwise he's just not willing to follow through and see the repercussions of what is happening. Now, Bryce, I didn't tell you that I did this, but Trump actually was asked about the taco trade.
He'd hate it.
And so I've got the clip that I'm going to play you, and fair warning, you're going to listen to it all the way through to the end.
Okay.
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, We'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? Because we have $14 trillion now invested, committed to investing when Biden didn't have practically anything. This country was dying. You know, we have the hottest country anywhere in the world. I went to Saudi Arabia. The king told me. He said, we have the hottest country in the world right now. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that.
I knew you'd go there.
It's called negotiation. You set a number. And if you go down, if I set a number at a ridiculous high number and I go down a little bit, they want me to hold that number, 145% tariff. Even I said, man, that really got up. You know how it got? Because of fentanyl and many other things. And you added it
that
up.
Really got up.
I said, where are we now? We're at 145%. I said, whoa, that's high. That's high. They were doing no business whatsoever. And they were having a lot of problems. We were very nice to China. I don't know if they're going to be nice to us, but we were very nice to China. And in many ways, I think we really helped China tremendously because, they were having great difficulty because we were basically going cold turkey with China. We were doing no business because of the tariff, because it was so high. But I knew that. But don't ever say what you said. That's a nasty question. Go ahead. To me, that's the nastiest question.
Oh, my God.
I wanted to warn you that we're going to listen to it to the end because sometimes I think we don't listen to the full clip.
Yeah. He's lost the plot.
It rambles.
He's lost the plot.
I'm surprised if the Saudi crown prince told him that
you have the hottest country. Yeah, I know. Anyway, to keep up with all the headlines, as Ren said, make sure you subscribe to our daily newsletter. 6 a.m. every day, we'll send you a summary of all of the global headlines around the world so you can stay up to date with what is going on. There'll be a link in the show notes or description below.
A cheat sheet is a quick reference guide or concise summary of important information.
One of the world's greatest investors, famous for The Big Short, has sold everything in his portfolio except for one stock. Today we're going to look into it. Ren, this is Cheat Sheet.
Yes, Cheat Sheet, where we look under the hood of the top investors and see what they're buying. Today, we are talking about Michael Burry.
Yeah.
As you said, famous for calling the global financial crisis. Well, calling the housing market collapse that led to the global financial crisis in America. From there, he's built himself a bit of a cult following. If you see Michael Burry's picture on a YouTube clip, it seems to do well. So we're going to try and juice some of that Burry magic to grow our YouTube. But Michael Burry, I find interesting because no one moves their portfolio as much as him. If we think back over the years, times we've spoken about him, do you remember when he liquidated everything in his portfolio apart from those private prison stocks?
Yes.
Yeah. To be fair to him, he was early on China as it rebounded.
Yeah.
And that was another time where he liquidated most of his portfolio but just held China. This guy loves liquidating his portfolio.
Yeah, back to square one.
But if there's one thing I know about Michael Burry, he's called 100 of the past 2 recessions. He loves.
He does.
He loves. He nailed the GFC, he loves calling a recession. So that context in mind, let's have a look at his latest 13F and how he has moved his portfolio.
As he said, he has sold everything except for one company, and the sole company that is sitting. Well, I guess to just illustrate what he's sold. Last time we spoke about his portfolio, he was long China, but he sold out of Alibaba, Baidu, JD, Pinduoduo. There are a bunch in there that he's sold, and there is one stock that remains, and that is Estee Lauder.
To clarify, it's not one stock that remained. This is a stock he didn't own. If you look at the 13F, it's added 100% of the holdings.
True.
So it's a completely new position.
True.
Sold everything, only bought Estee Lauder.
So what is Estee Lauder? It is a global beauty products.
Makeup and the like.
Makeup and stuff. They manufacture and sell a raft of beauty products.
So he also has a number of shorts, but let's hold on Estee Lauder for a minute because I wanted to have a bit of a look. So Estee Lauder is down 82% from its 2021 highs. But if you want to take the bull case for Michael Burry, you could say its gross margins look really strong. So Estee Lauder's gross margin is 73%, L'Oreal's 72%, Elf which just bought Hailey Bieber's beauty company, FYI, 68% gross margins, and Coty is 63% gross margins. So from a gross margin point of view, you're like, oh wow, Estee Lauder, it's been smashed, but it's holding up okay.
Well, is that flowing through to profit?
It is not.
Oh.
So for people unfamiliar, so gross margin is the revenue you make from sales less your cost of goods sold. So like the cost of making the product. But then net margin is your actual profit margin, and that includes all your other costs, like your team headcount and your offices and your marketing spend and all of that stuff. Their net margin is getting pumped. So to start with, revenues remained basically flat in that time that the share price is down 80%. 16.2 billion in sales in 2021, 15.6 billion in sales in 2024. Fine.
Yeah.
No major issues there. It's a large, slow-growing, pretty boring company. The profit in those 4 years, 2.9 billion, 2.4 billion, 1 billion, 390 million.
Wow.
Or expressed as a percentage, their net margin, 18%, 14%, 6%, 3%.
Wow. So declining in all major, some of the key financial metrics of the business. Surely Burry there must be a turnaround story
Well,
here
he must
we're
see
seeing.
it.
Yeah.
It's ticked up a little bit since he bought, or at least since his 13F was filed. But honestly, the amount of opportunity that's out there in the share market, it's probably not the company that I would get excited by.
Yeah, it's fascinating. Well, we'll continue to watch that one as he releases his 13Fs. But that's not the only interesting thing that is part of his portfolio, Ren. He has now put on some big bets against, or in other words, he's shorted a number of very large cap, well-known companies. The most well-known there is Nvidia. He's shorted Nvidia. He's shorted 900,000 shares. But he's going to be hurting from that.
Yeah, he will. So the filing date of the 13F is 31st of March. I keep coming back to this date because it is an important caveat with 13Fs that we get a snapshot at the end of every quarter, or like, a certain number of days after the end of every quarter. But it's only a moment in time. So we don't know like when they're buying or selling or what they're doing around it. But assuming that he has held these shorts to today, he would have been smashed because since the 1st of April, Nvidia is up 23%. And that includes the Liberation Day fall. So 1st of April, then 2nd of April, Trump does Liberation Day. Nvidia falls 15% in a week. Everyone thinks the sky is falling. But then from there, it's absolutely ripped, and it's made up all of that loss and then some, and it's up 23%.
And it's had great reporting.
And then, it will be up more now because of this most recent report.
Yeah.
But maybe he sold at the right time. Maybe he sold in that post-Liberation Day fall. But the other thing I found interesting in his short book, so you mentioned earlier that he was long China and he was had invested in Alibaba, Pinduoduo and the like. Well, he turns around and shorts a bunch of those companies. He shorted JD, Pinduoduo, Alibaba and Baidu.
It's almost like he's like, I've got the return on the upside. Now I think they're overvalued. And so I'm going to try and get some on the downside, not only sell out, but I think they're overvalued. So let's hope that plays out and we capture it through a short position. So fascinating movement, highly active. If you want to find these 13Fs, you can do so. Just Google it. We use a platform called Ticker. We'll put a link in the show notes. It's one of the best platforms that we use for stock information. We're going to take a quick break, and on the other side, we're back with the Unhelpful Desk, where we provide very general answers to specific questions from the community. We'll be right back.
Hello, IT.
Hello, IT. Have you tried turning it off and on again?
Have you tried forcing an unexpected reboot?
This is the Unhelpful Desk, where we provide very general answers to specific questions, because we only can give general advice here at Equity Mates. And the first question comes in from Yana.
Hi, I have already invested close to 100,000 in my personal investment account. Now my partner and I are thinking about starting a joint investment account, but we plan to contribute about 3,000 a month together. I am wondering, does it make financial sense to have both a personal and joint investment account, or could that end up costing us more in fees or tax complications? What's your outlook on managing investment like this as a couple? Thank you.
Well, thank you for the question, Yana. And I think the first thing to say is well done on building that portfolio.
Yeah,
that's a huge effort, and it wouldn't have been easy. And so you should be commended there. But the question then becomes, partner comes into your life, you've got your investment portfolio, how do you then manage it as a couple? Something that I'm sure you have gone through, Bryce.
Yeah. This is the perfect unhelpful desk question because it's so personal.
Yes.
The biggest thing here that we can just not provide any advice on whatsoever is the tax implications.
Well, the tax implications, but also like it's personal because it relates to your goals and how you and your partner manage money. I think that's one of the most important things. It's like there's no universal answer because if two people have highly strung type A spreadsheet style personalities like Bryce, where every dollar is accounted for, then like you guys go for it. But like Bryce and I together would probably have separate accounts.
Yes.
So what can we answer generally? Let's talk about like some of the pros and cons, how you can think through the problem, and maybe how you and Harriet do it as well.
Yeah, I'm happy to talk personally, but generally, look, from a fee point of view, your brokerage accounts the fees aren't going to change too much, whether you're investing together or personally, you're still going to be paying brokerage on all the trades. So that's not really going to change. I guess the fees for the underlying assets, there's no real benefit in being joint or being separate if the total amount you're investing still remains the same.
Yeah, like if you've got $100,000 in the ASX 200 ETF, you're paying the 0.04%.
Yeah.
Or if you've got 52 accounts with 50,000 in each, you're paying the 0.04%.
Exactly.
If having separate accounts means you're doubling up on buying the same things, you might end up paying more in brokerage, but like that's just a thing to be mindful of about the platform you use.
Yeah.
Yeah.
So then you start having to really think about the tax implications because this is where you're going to have the biggest difference and the most to consider. Obviously, if you're investing individually, it's pretty straightforward. You are responsible for the income generated from that investment and you only. Yeah. It's straightforward. It's your personal tax and away you go. When you start getting into joint accounts though, you start having to split the income generated by that investment. Generally, it's a 50-50 split, but you do need to consider it because obviously what that means is you and your partner might not have the same tax situations. You might have different tax brackets. Going forward in life, you might have different situations as well. And so you need to consider what impact investing together is going to have on your tax. I guess to put an example to that, I thought that, Harriet's going to have periods where her income is going to be considerably reduced going through maternity leave, for example. I thought that it would be better to always have investments in her name because I would be earning more, I would be paying more tax over that period of time. But it was, and maybe this is naive, but it was advised that it would actually be better to not have joint investments and have the investments in my name because I'm going to have more tax to try and reduce if you're looking at doing debt recycling or the like. So it's definitely worth talking to someone, in my opinion, when you're looking at considerations like this.
Yeah. And then to talk to my personal experience with Alice, we haven't combined accounts, but it's just because we both have systems that work for us in terms of how we manage our money from where we get paid to how we cover our expenses and how we invest. So we just haven't felt the need to combine our expenses. But then we obviously, when we bought the apartment, that's a joint account and we put money into. So I think it would just be a change over time thing. But, we're no worse off because we haven't combined our accounts to date.
Yeah.
So I think, it's very personal, if there's a tax strategy component to it, maybe that's some of the planning. It's also just then, as we said earlier, personality. If doing it together keeps you motivated, keeps you on track, keeps you accountable towards those joint goals that you have, then that's a great consideration. But if it doesn't, then there's no, you shouldn't stress either way.
No.
6 of one, half a dozen of the other. The main thing is that you're investing.
Yeah. I guess to close out, Harriet and I have sat down and agreed that we would both invest an X amount from our salaries. So we're both kind of investing as a family unit, but doing it individually.
Yeah. Do you do spot checks on her account?
No. Show us. Prove it. No.
All right. Well, Yana, hopefully that helped somewhat, obviously in general terms. But again, congratulations on getting to where you are. Let's go to Shane, who also had a question that we can kind of answer.
Hey boys, how's it going? So we've got 4 mates and we're looking at buying a house. Is it better to go tenants in common and just deal with it that way? or a trust fund, or even starting a business to buy the property under. Any tips and tricks would be much appreciated.
Love it, Shane. Thank you for the question. Head to equitymates.com if you would like to leave a voicemail for us to answer on the Unhelpful Desk or throughout the show. Let's start with the three options that Shane has put forward. First is tenants in common, the second is trust, and then the third is company. Now, tenants in common...
Just to take a step back here, if you buy a property with your partner, you'll often be asked, do you want it to be joint tenancy or tenants in common?
Yeah.
And joint tenancy is where like you each own an equal share of the property, and if one of the people die, the other party basically takes over the whole property. And then tenants in common is more of like a company share arrangement sort of thing where you each have a percentage share of the property, and those shares can be unequal, and in some cases, you can buy and sell your share depending on the agreement that's in place.
Yeah.
So most people will just generally do joint tenants.
Yeah.
But obviously for Shane in this situation with his mates, the question is tenancy in common versus trust versus company.
Yeah,
So explain those three options.
So yeah, tenants in common, as you said, it's where you get like a defined ownership in the house. So you could split it based on who puts X amount in or whatever it is. It doesn't have to be equal. You could do 25% in each in Shane's situation for mates, but it can be equal, and it's recorded that way on the title of the property. A trust is where the trust buys the property and each person is either a beneficiary or owns units in the trust. And then the third is where you set up a company and the company buys the property, and then each person owns shares in the company. Each obviously have pros and cons and tax advantages and all those sorts of things.
So they're the three options. There's obviously different pros and cons, but unfortunately, Shane, they are specific to you and your mate's personal circumstances, what your goals are with the property, and how long you want to own it for, what you want to do with it. So we can't tell you what the right of those three options is for you, but what we can do is generally give you some pros and cons to think through. So Bryce, let's start with tenants in common. What are some of the factors to consider?
First is it's simple and it's cheap to set up. You don't need any of those tax structures, or you don't need any of the structures that come through companies or trusts. It's pretty straightforward. You get direct ownership as well, so you get direct access to capital gains. You can also use negative gearing.
Sorry, direct access to capital gains probably wasn't clear. You get access to the capital gains discount. Yeah. And the negative gearing tax benefits.
Yes.
Yeah.
So a big, consideration when it comes to investment properties.
Do you? I'm not sure if you know this, but would you get access to like first home buyers if you and your mates?
Investment properties don't get first home buyers.
True. Yeah. Good shout.
Flexibility in ownership, as we said, it doesn't have to be equally split. So whoever contributes more can probably get access to more share of the property. And you can sell and transfer your share between your mates or whoever, really.
Sometimes tenants in common don't want to do that, and so they'll have a separate agreement in place to be like, you can't, or you have to sell it to us first or whatever. So just make sure you guys have that discussion before
flogging it off to someone at the pub.
Before you buy. Yeah.
The cons, though, you are all personally liable. So if one of your mates spends too much money at the pub and can't afford to repay the loan, you guys are all on the hook for it and are responsible. Creditors can come after your share. There's no sort of asset protection that you might get in a company or a trust. You guys might get in an argument, so there's potential for disputes, and also you've got to all agree on the way forward.
Yeah, so that's the tenants in common route. If you went down the trust route, either a discretionary trust or a unit trust, some of the things some of the pros, I guess, they can offer asset protection and flexibility in distributions. So, if you're getting rental income, you can then have flexibility about which of the beneficiaries get what. They're easier to manage changes in ownership if someone wants to sell units of the trust. And they might be better suited if you want to sort of grow a portfolio of properties. It might be easier to manage than having multiple mortgages as tenants in common under your personal names. Some of the cons are that way. There's no capital gains discount in some cases. Again, you got to get tax advice based on the structure of the trust. Similarly, you may not get negative gearing benefits. Again, depending on the structure of the trust, the losses may get trapped in the trust, which is a dramatic way of saying they just might not flow through to the beneficiaries. Setup and maintenance costs are high. You have to set up the trust. You've got to get lawyers, accountants to manage that. And then every year you've got to file returns for the trust as well. The more structures you have in place, the more complicated it can get tax-wise.
Yeah, big time. Well, that's a good flow into the company structure, probably one of the more complicated. I guess to start with the pros, though, you do limit your liability through a company and you do get more sort of asset protection, probably the biggest pro. And similar to trust, if you want to sort of set up a property portfolio going forward, this might be a better structure to consider. Changes in ownership are easier as well via sort of transfer of shares and the like. But there are a number of cons. Again, no capital gains discount because companies pay full capital gains tax. You don't get the advantages of negative gearing. The losses actually stay within the company, not with you personally. The company tax rates apply, 25 to 30%, and you're also taxed on dividends from the company personally. So you're somewhat double taxed there. And it is costly to set up. You have to comply with ASIC, do company tax returns, potentially audit, you name it. There is a lot that goes with setting up a company.
So let's put it all together. What if you and I were buying a place together as an investment? What route would you go down for us in our circumstances?
In our circumstances, I would probably be going down. I'd actually be going down B or C, trust or company. Because I would be looking at it as this is not a one-off. This is the Wren and Bryce Holdings property portfolio.
Okay. Yeah. So I guess in that situation, Shane, make sure the other three mates if you want to go down those routes, make sure you want to go long-term with them.
Yeah.
But
our good mate Sam Gordon would probably be the best to answer this.
Yeah.
So
yeah. But I know that the banks more and more are optimizing for tenants in common. Well, I guess like they're more they're facilitating more. I saw some stuff from Commonwealth Bank where I think they're just seeing more of it.
Yeah, I
they're
think people are saying we can't afford
siblings.
We can't afford to do this on our own. Let's team up, get a foot in the door, and then go from there.
And so, if that is the case, if you just want to get your foot on the property ladder and just start, and you don't have property empire ambitions, and it's just like, we'll do this, we'll build some equity, we'll sell it, and then we'll all go our own separate ways. Like, you probably don't need to over-egg it beyond tenants in common.
Yeah.
And you can speak to a mortgage broker or a bank because they're definitely getting more of those inquiries and they'll have a playbook that they run.
Love it. We'll keep the questions coming. Thank you so much, Shane and Yana. We love hearing from you guys. If you would like to ask us a question, head to equitymates.com/contact. Link in the show notes or the description below. Leave us a voicemail and we'll make sure that we answer it on the next Unhelpful Desk. But that does it for us here at Equity Mates. Thank you so much for listening. As always, we appreciate the support. If you could rate the video, leave a comment, also leave us a rating and a review in your podcast app, wherever you are consuming this content. We really appreciate any sort of feedback coming our way. But Ren, that does it for us. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.